Welcome back, Alpha Hunters. Hope you, ladies and gentlemen, are doing well today. Today was the last market close for 2022. So we will see what the market has in store for 2023 as that starts this next Tuesday. Remember, Monday will be a holiday. The markets will not be open. But let's get into seeing what the market did this last week of the year. So last week I kind of thought we wouldn't really do too much this week, but I did think earlier this week, maybe like Tuesday, Wednesday, we'd probably pop higher and then come back down and settle out like Thursday, Friday. We wound up doing a little bit of more of the opposite of that. We wound up dropping early in the week, Tuesday and Wednesday. And then jobs numbers came out Thursday morning. The market responded pretty positively and then kind of settled in. And we saw a lot of buying come in on the last hour of the trading week. So just a quick look here on the 15-minute, kind of what happened. Not really too much happened on Tuesday. A little sell down, a little hangout action. And then on Wednesday, saw a little bit of a sideways move for the beginning part of the session, and then just a sell down. Nice little pop midday, and then just continued selling into the close. With then Thursday, jobs numbers come out, pop a little bit higher, and then held pretty much flat for the last couple of hours to finish out that trading day. We didn't really move too much outside of that first roughly 2 hours. So that was pretty much how Thursday went. And then Friday, nothing major. I think the futures basically just kind of traded down all night. It wasn't really anything major. Just saw a little sideways action, a little rollover here midday. And then that last hour, woo, man, just kind of took off. This was a lot of people, that had to be allocated into certain positions. They wanted their, fun statements that go out to clients and customers and stuff like that to look and appear a certain way. So they needed to get allocated. And one of those areas where we saw a lot of buying in that last hour was definitely risk on names. Okay, a lot of tech, a lot of consumer discretionary. Consumer discretionary performed very well in that last hour. So did tech. So yeah, we saw a lot of that kind of allocation going on that last hour. So this is typically what you see in the last week of the year, but we didn't really see too much of that. And this is why they call it the Santa rally, because a lot of funds do have to allocate in that last week, get their statements ready to go. But we saw a lot of that kind of happen in that last hour. So let's take a quick look around and see, just kind of how the Qs did. The Qs were definitely a little bit weaker the early part of this week, as it just broke down last week's low. Definitely a nice little bounce back on Thursday, Friday, especially on Friday in that last hour. Definitely a lot of strength there in that last hour. So almost got back to even on the day, but didn't quite get there. So yeah, Qs saw a lot of buying that last hour. Is that a game changer? No, I don't think it is. But just allocations, funds having to change and allocate positions at the year end. It's funny, they bet against all these stocks for most of the year, and then the last day or so they got to allocate into them because they want to show, hey, yeah, we do own those high quality stocks. It's just how it goes. But you got to play the game and understand the game, and it's just noise. It's not really a big deal. They'll probably unwind those positions as we get into next week, and not really a big deal. So let's take a look at the VIX. VIX didn't really do a whole lot this week. Had a nice little spike up there on Tuesday, but nothing really major, concerning, or directional too much on the VIX this week. So just kind of hanging out, waiting. As the market has been rolling over here recently, the VIX has just been hanging out. And if you are bearish or trying to be bearish on the market, this is kind of what you want to see. You want to see the market to continue roll over, continue to trend lower, and the VIX kind of stay in this 19 to 24 type range. As long as it can stay in here, that would be perfect, as long as the market keeps rolling lower and gets back to the lows of 2022 sometime in 2023. Take a look at that dollar. Yep, definitely saw the dollar drop off today. We'll see if this is a false breakout. We did snag the low from Wednesday, December 14th today. Didn't really hold below it all that strong, but it is something to note that we did get below it. So maybe we do see it break below maybe early next week and then see it start to rally. I was definitely thinking this was getting a little bit too compressed. Might have saw the bullishness, but obviously Thursday, Friday came in this week and just pushed it back down. So I do think we'll see a pop on the dollar probably pretty soon, maybe over the next week, 2 weeks, when we get into January. but I wouldn't be looking to be bearish too much right here on the dollar for now. The US 10-year yield looking pretty good. Had a little bit of a bearish day yesterday on the rates, and then it came right back today. Took out the weekly highs today, but didn't close over that Wednesday high. Came back down. So I would expect this to kind of keep going higher. We did get roughly into that 3.9 area. I mentioned this over the past couple of weeks. Look for this probably to move to that 3.9 area. And now I think it's going to settle in here a bit, maybe a bit longer. And we'll see if it pushes higher. I don't know. I wouldn't be willing to bet it does, because this was a very nice double top kind of breakdown. Now we're retesting into that little neckline area of that double top that we had back in October, November. Yeah, I don't know. It's kind of just a wait and see. If it can kind of move sideways, settle in here and push higher, then yeah, okay, it can push higher. Or does it roll back over? That's also very viable. Have no real takes on the 10-year right now, but as far as the inversion yield, we saw the inversion yield continue to make new highs this week. Tuesday, Wednesday just continued to push higher. Got right to that 100 moving average last time we got there. Yeah, we saw it come right back down back in October and then continue to push lower as it went all the way into December. This time around, I think it's a little bit different. I do think this inverted head and shoulders pattern that we had shape up down here from the end of November to the beginning-ish part of December. I think that was probably the bottom here on the 10 and 2-year inversion. So I would expect to probably just at least settle out in here for the beginning part of January. And that's going to be kind of a key theme. I would expect a lot of people to settle out on some things here in the beginning part of January and then start to make some moves one way or the other. The GLD, one thing that's very interesting here is with the dollar breaking lows from earlier in December, the GLD did not make new highs. So kind of interesting. Maybe the GLD gold losing a little bit of its steam and maybe it's due for a bit of a pullback. I do want to see this thing pull back, so I would like to get in bullish at some lower levels. So we'll see if that happens. But this is shaping up so far to be a pretty nice higher triangle pattern. So yeah, I mean, it looks bullish. Like, I can't argue against the bullishness, but to me, I would just like to see it come back down. And maybe we'll see that maybe in like February, March, April, something like that, if everything's getting caught up in the market sell-off. The HYG, this was real interesting this week, and you really need to be paying attention here. Tuesday and Wednesday, look at how much this thing got crushed. Woo, man, this thing got annihilated. And really what happened over Thursday and Friday this week, this thing came right back into the low that it put in on December 20th, retested right into that. Maybe not quite, but if it goes a little bit higher over January 3rd, maybe 4th, I would look for that little retest to probably get sold off on the HYG and continue moving back bearish. But yeah, this breakdown was really strong, much stronger than the stock market did. And obviously you can see that the bullish days on Thursday, Friday didn't get back even close to the weekly highs. So yeah, definitely be watching the HYG. Obviously the HYG and the LQD are telling you there's something going on in the bond market. Tuesday and Wednesday on the LQD, these investment grade corporate bonds, they're pretty weak. Okay. Tuesday, Wednesday, so obviously selling off. Thursday, a little bit of bullishness coming in. Pretty much everything was bullish on Thursday. It was a nice 2% update pretty much on the market. So it's kind of hard to find anything bearish that day. But Friday, as the market rallied pretty good, you can see the LQD did not even come close to rallying, even somewhat hard. Even the HYG saw a little bit of a rally. LQD, not nearly as much. So I'd expect us to continue to see these bonds, the LQD, HYG, probably just to keep moving in the bearish direction. And maybe the stock market plays catch up a little bit later on. So we'll just have to see how that kind of plays out as we get into January. So it is the year end. And one of the things that I do want people to understand that you should be very much in a habit of doing is keeping track of your performance, right? I do keep track, and I've made it very clear I keep track of my performance every week. I keep track of all my trades, but I do my analytics like every week, just to kind of keep tabs on like what strategies are working, what strategies are not working, that kind of stuff. That way, if the market goes from a bearish market to a bullish market, I know what strategies to get into. If it goes from a bullish market to a bearish market, like we saw at the beginning of 2022, I know what strategies to start using. So I have shown this off before, and since we are now ending out the year, the total portfolio was up 63%. Now, not the best. I'm sure there's other people out there that did a lot better than I did, and I hope you did. But what you need to understand is if you don't get in the habit of doing this, you don't understand where you are seeing your best performance, right? You don't see what strategies are working, what strategies are not working. Why do you want to keep using strategies if they are losing you money? So you want to keep doing this all the time as much as possible, but not to the point where it's cumbersome, okay? And you want to make it as easy as possible. I do keep track of my stuff in this Excel spreadsheet, but for my year total on trades, I was up 63%. I didn't do any long-term stuff. I allocated and combined some accounts earlier in the year, at the end of last year and beginning of this year. And I didn't really even start trading this year until I got into March. I was done kind of combining on my accounts. Yeah, I did 63% up on the year. Now it was kind of rough in April and May as the market was still kind of figuring out its ebb and flow. And I can kind of get a little bit better grasp on the market. I see what was working, what wasn't. And obviously, yeah, that really late spring, early summer timeframe was a bit rough, and it's fine. You know, you just got to realize, you know what, I got some losses. It's okay. I just make some adjustments, and you can see the second half of the year did a lot better. And earlier today on the live stream, I was showing off kind of where a lot of the performance kind of came from. A lot of the outperformance on the portfolio really, or on the trading side of the portfolio, was on some of these Apple long terms. Now, it's, you know, I call it the Apple long-term stuff, but that's just the bucket I kind of put it into, just because it was a little bit more on the longer term side of options. It's really kind of more the medium term side. Same thing with some of these SPY positions I was into. Most of the Apple stuff, I was only playing it bearish. And I really only started playing Apple bearish in August. And I made some videos about that, really kind of talking about as the market was turning in August, that Apple was really starting to underperform on some of those daily time levels. But between all the times I put AAPL on and took it off, this was wound up being my total performance on the year on AAPL bearish positions, roughly 9% gain on the portfolio. SPY, 64.5%, with a lot of the outperformance here coming in the second half of the year. We definitely had that bullish run in July to August. Definitely had a pretty good run on P&L then. And then the August to October sell-off, definitely had a pretty good P&L then. And I actually, you can see here this little dip. I started getting into a little bit more of a bearish position before we kind of topped out in December. But, you know, it's not a big deal. It was much longer term. And I was willing to say, hey, if it goes a little bit higher, then I'll just add to that position. And that's kind of what I did. And that was really around the CPI numbers that came out in December. So, yeah, not too bad. And those were the areas that really worked best for me this year. Obviously, you can see the other here. This is a lot more of the shorter term vertical option trade. If you come by the live stream, you know I do a lot of weekly vertical options. They are very, very profitable. So this helped offset a lot of the other trades that I was wound up losing on earlier in the year that is bucketed in there. I think my vertical option position I mentioned earlier in the live stream was up 5% on the year just on that strategy, but it's helping offset the losses that are also sitting there. So I guess the other area without the vertical option position is probably a negative 7%. So that's why you see a negative 2% there. And then some other long-term stuff, which is like some leap plays that I have sitting on the portfolio. Obviously they're sitting at losses right now. And, you know, that's kind of just how the portfolio went this year. It was pretty good. You just got to realize the times you need to make adjustments and, you know, cut the times when strategies are not working, you know, cut them. You don't need to do all your strategies at all the time. As being a trader, you need to be flexible. You need to be understanding of when to be bullish and when to be bearish and how to maximize your profits on those timelines. And one last thing here, you know, even though I was up P&L wise 63% well, how much was the market down this year? What is it down? It's going to end down, I think, a little bit over 20% on the year. And if we do go back and check that, we can very easily check that real quick. So if I ended the year up 63% on my P&L, and the market actually wound up finishing down, I guess roughly, what is it? Roughly 20%, about 20%, about 19.5%. Okay, so basically say 20%. So my alpha for the year was roughly 83%. Okay, so like I said, I've mentioned it before, alpha is the most important metric to traders. You want to know if you're beating the market or not, and generating an 83% alpha is really good. That's what we want to be doing. Pretty good there, and we'll see if we can beat it next year. And one of the things I did mention to the live stream earlier is I want to come back and review kind of my bear market performance, potentially whenever we get to the bottom, I feel like the bottom of the bear market, come back and look at performance of what worked, what didn't, and start to set up then for the next bull run and start to kind of adjust some things then. So the next thing I'm going to do is I want to show off really just some comparisons, like how well our current bear market is tracking two previous bear markets, the one from 2000 to 2002 and the one from 2007 to 2008. So let me go ahead and set that up, and I'll come back and talk about it here in just a sec. Alrighty, I'm back. Okay, I got it set up. So the purple that you see drop off here, or if you're colorblind, the one that drops off a lot faster here, this is the one from 2007 top to 2008 and 9. The bottom was in 2009 actually. So this is the pace of it. The pace and feel for 2000 2002 bear market is the orange, or the one that kind of goes a little bit farther out to the side here. And really I want to just show off, like, I know there's a lot of people calling for like, oh my gosh, look at how the comparison is to this 2008 bear market. And we are pretty close. We are pretty close to tracking how well of 2007, 2008, 2009 bear market we are on. And not to say that it's absolutely perfect. I try to get really the tops of both of these chart patterns really on the money at the top, and then really kind of see where they end out. And what you kind of notice here is both of them really have a pretty steep sell-off here coming up soon, right? The tech bubble and the financial crash, really we're at that same kind of time period where we should be seeing some strong weekly moves down. Now, obviously with the financial crash, it kept going, mostly because we had some major financial issues going on in the markets and everybody freaked out. I don't think we're there. Okay, I don't think we're going to have a Lehman and Bear Stearns type moment, mostly because it doesn't seem like we have that kind of moment. Financials are much better kind of position than they were back then, especially for what we know about derivatives. Back then, derivatives and swaps were a hugely messed up market. A lot of people just didn't understand how much leverage was not being accounted for kind of off the books. And those are the times where you get huge market panics. Now, what you'll see here on the tech bubble bust was we did have a pretty good sell down. And really once we broke the previous low that it had, which was kind of way up here in that market, it had a pretty good drop. It did have a pretty good drop. So, below, if we break below this low, are we going to have a pretty good drop? I would assume so. But I don't think it'll take this long to kind of play out. I think, somewhere between like February, April kind of makes sense to kind of get down into these lower levels. And if you've been kind of watching the channel for a while, I'm really looking for that 3,100 here on the SPX. We're looking at the SPX here. So 3,100 here on the SPX to roughly 3,000. Or 310 on the SPY to 300 on the SPY. Sometime, February to April kind of time frame, that'd be my guess. I think we'll be a little bit more in the medium range in between these two type markets, or the pace here kind of going forward. But either way, both times at this point in time on these kind of bear market moves, the one from the financial crash and the tech bubble, once they break the lows, they both had a very strong move in the bearish direction. Obviously, the financial crash was a crash, but the tech bubble busting, was a very strong move as well once it took out this low. So once we get this far into bear markets, we do typically see a lot stronger moves in the bearish direction, especially when we continue to break lows. I mean, that just kind of makes sense. If we do look a little bit more at the longer term, there's not much in the ways of support for us to bounce off of. We got to go to major structural kind of support levels to really kind of get out of it. And that's really what happens in bearish moves and bear markets, is they're more technical driven than fundamental driven. Very rarely are they actually fundamentally driven. You just got to go somewhere where all the volume is sitting and you just stop selling. So that's one reason why I do like the 3,000 level, or 3,100 level, really 310 on the SPY. Once we get there, there's a lot of support and resistance kind of at those levels. If we just kind of look at the SPY here for a sec, and what you'll see down here in this blue box or so is you have the longer term exponential trend line, which is this more solid green line, and this thinner green line that you got coming up here. That's the bottom that we've had since 2009 and the new low that we made at the bottom of COVID. So there will be buyers off that trend line too. So there's just going to be a lot of buyers in this level. Nobody knows for sure what the actual number is we will actually stop at. But once you kind of get into roughly these numbers, it starts to just get really whipsawy, and you just got to say, okay, the reward to risk is no longer in the bearish direction. It's actually more in the bullish direction. And you just gotta start buying, longer term stuff. And, we'll look to talk about that as we get there. But really, that's about it for the year. We'll look to adjust things as we get into Q1 and Q2, as hopefully we start to find a bottom on the market and start to look to being more bullish, setting up on bullish strategies, and generating some cash flow with some of our longer term positions. But as we kind of go into next week, I got two possible scenarios. Really, I could see the market going either way on January 3rd. Obviously, you can see here on the SPY on the weekly, we have a very nice inside week this week with a lower wick again, much like last week. So we're definitely building a little bit of a compression here, and we could definitely pop bullish or pop bearish. But if we pop bullish, I think we'll probably just make a run up here to the 390 to the mid 390s, somewhere up in this zone, and then probably start to make a solid rollover, as we go into January, the end of January, go into February, and start to make the continuation lower on a push. The other possible scenario that I could see us kind of doing as we go into next week and the new year is really kind of just sell off. We sell off pretty good, as I think there might be a lot of people holding gains on stock positions. And I'm not talking about like from this year. I'm talking about from the past several years. People that are owning stocks in AAPL, Microsoft, Alphabet, Amazon. There's still a lot of capital out there that people are sitting on gains. And if we see them come out and liquidate, that way they don't have to pay taxes this next April. They can pay taxes in April of 2024 on those positions and on those gains as they liquidate them starting next week. And then, we see some buyers come in, try to buy the dip here a little bit, retest into some of these levels, and then push lower later on in January. That is really kind of the two scenarios I really see playing out here. It's really going to depend, on January 3rd and 4th. Are people sitting on gains from the longer term stuff and they didn't want to pay taxes in this April, or are they going to pay taxes next April as they liquidate them on January 3rd and 4th? Or is there a lot of bears out there from this year that have been sitting on gains and they didn't want to pay taxes this April and they're just waiting to kind of liquidate? They'll buy, they'll cover their short positions, they'll push the market up, and they don't have to pay taxes this April. They can then use that capital to reposition and get back bearish again. So who knows how it's going to kind of play out, but I do expect some early next week volatility. I do expect that. I think we will make a pretty strong move as we come out of the new year on January 3rd and 4th. And people probably just start to liquidate some positions. They don't have to pay taxes on it this year, and they can reposition possibly later on in the year. Alpha hunters, y'all have a great and happy new year. Be safe. I've enjoyed learning from you fine people, and hopefully you guys have learned something from me or got some value out of what I've been doing. That's really all I want to do, is provide some value to you, and we will continue to be hunting next year for that alpha. Alrighty, take care, alpha hunters.